Hello, this is your daily dose of financial market trends. Gold just posted its biggest single-day surge in months while tech stocks violently diverged. Nvidia up, AMD down 7%. And US-China tensions are escalating fast. Let's break down what's moving markets this Thursday morning. Heading into today's session, yesterday's close showed a mixed picture. The S&P 500 finished at 77.23, down about 0.6%. The Nasdaq slipped harder, dropping 0.8% to close at 26,363. The Dow bucked the trend, gaining 0.5% to 54,349. The VIX ticked up slightly to 15.85, while the 10-year Treasury yield eased to 4.62%. Let's talk about what's actually driving attention today, starting with JP Chase, which is lighting up across the board right now. The nation's largest bank is catching real momentum from multiple angles. Retail investors are piling in. Insider activity is flagging it, and it posted a modest gain yesterday amid broader market weakness. JP Morgan tends to be a bellwether when geopolitical uncertainty rises, and right now traders are positioning it as a safe harbor play in financials as trade tensions escalate. If you're watching the health of the banking sector, JPM's relative strength matters. Next up is GLD, the gold ETF, and this one's seeing explosive interest. Gold surged over 4% yesterday on volume running double its normal pace, and the chatter around it has absolutely spiked. When you see gold moving like this alongside elevated geopolitical risk, it's the classic flight to safety trade playing out in real time. Investors are hedging against the uncertainty we're seeing in US-China relations and potential Fed policy surprises. Gold doesn't care about earnings or innovation. It cares about fear, and fear is clearly in the air right now. Apple is also making waves, posting a 0.5% gain that might not sound like much until you realize it's happening while the broader Nasdaq was down. The stock is showing resilience across social platforms and geopolitical watch lists, likely because Apple's been working to diversify its supply chain away from China for years now. In a trade war environment, that positioning suddenly becomes very valuable. Investors are reassessing which tech names have real insulation from tariff escalation, and Apple's making that short list. And then we've got the semiconductor split that's turning heads. Nvidia up 3.5%, AMD down 7%. And both moves tied to the same catalyst. Reports suggest SpaceX's first earnings call contained one critical word, likely a chip supplier preference, that sent investors scrambling to reposition. Nvidia is clearly on the winning side of that equation, reinforcing its dominance in AI and high-performance computing, while AMD is taking the hit. This kind of single catalyst divergence is exactly what traders watch for in a sector as concentrated as semiconductors. Let's zoom out to the bigger forces shaping markets right now. First, US-China sanctions are escalating. China just retaliated against recent US actions by imposing its own sanctions and tightening export controls on drone technology. The bull case here, sitting at 35% probability, is that both sides establish dialogue channels soon and freeze further retaliation. If that happens, risk-on sentiment would flood back into tech and semiconductors as supply chain fears ease. And Chinese consumer-exposed stocks would rally hard. The bear case, at 45%, is that the US responds with even stricter tech export restrictions or investment screening targeting Chinese firms. That would renew disruption risk across advanced semiconductors and AI hardware, pushing money into safe havens and pressuring any growth stock with meaningful China revenue. Second, the Federal Reserve just issued its latest FOMC statement, and the market's parsing every word for clues on the rate path ahead. The bull scenario, 30% probability, is that the Fed signals increased concern about growth risks and opens the door to near-term rate cuts. If that happens, duration-sensitive assets would rally sharply. Growth stocks, especially tech, would outperform as discount rates compress, and financials would face some margin pressure. The bear case, at 40%, is that the Fed sticks with higher for longer guidance, citing persistent inflation or a resilient labor market. That would send long bonds down, push rate cut expectations further out, and favor value sectors and financials over high multiple growth names. Third, we're seeing ECB policy divergence from the Fed. The European Central Bank just announced its latest policy decision, while wage data shows negotiated wage pressures stabilizing around 2.7%. The bull case, 35% probability, is that the ECB signals rate cuts in sync with Fed easing, creating transatlantic monetary alignment. That would lift global equities, especially multinationals, and stabilize the euro-dollar exchange rate. The bear case, 40%, is that the ECB maintains tighter policy relative to the Fed due to that wage stability. That would weaken the dollar against the euro, increase currency volatility, and create hedging costs for multinational firms while pressuring European equities. On the housing front, the 30-year mortgage rate sits at 6.66%, down modestly from a year ago, while existing home sales are up nearly 3%. The catch? Inventory is building to 9.3 months of supply, and home prices are barely growing at 1.1% annually. We're watching a cooling market where rising supply could pressure prices if demand doesn't pick up soon. So what does all this mean for your portfolio? 5 things worth watching closely. 1. Gold's surge is telling you something about market anxiety. When safe havens move this aggressively, it's worth paying attention to your overall risk exposure. 2. The semiconductor split between NVIDIA and AMD shows that even within the same sector, supplier relationships and positioning matter enormously. Not all chip stocks are created equal right now. 3. Financials like JP Morgan are acting as relative safe harbors in this environment, which historically happens when investors want equity exposure, but are nervous about growth names. 4. US-China trade tensions are escalating beyond rhetoric into actual export controls and sanctions. So if you hold stocks with significant China revenue or supply chain exposure, you need to reassess that risk today. And 5. The Fed's tone in its latest statement matters more than usual right now because the market is genuinely split on whether we're getting rate cuts or higher for longer. That uncertainty is driving volatility across bonds and growth stocks alike. Keep in mind, this is educational content, not financial advice. Always do your own research and consult a professional before making investment decisions. That's your Morning Market Digest for Thursday, August 6th. Markets are moving fast right now. I'll be back tomorrow morning with the latest. Talk soon.